Good morning for the two viewers that are out there. Welcome. Happy Monday. We're going to start shortly. The post went out. People are starting to click, to pop in. I'm sipping on my coffee. And we'll begin shortly. Now there's less people. Well, I guess today is an ideal day, right? To be at home. So I guess we can feel a little less bad about that. So we'll just wait for a few more. Good morning, good morning. Good morning. I hope that you're out there. I see right now on my end one viewer. Well, class doesn't start until 9, right? So today I'm a little early. Do, 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 do. My status. Let's see. Okay. All right, we have 4 people. Good morning, everyone. Good morning. It's almost 9. I have 8:59. Now it's 9. All right, so by the time you hear that, it's probably like a 30-second delay or whatever it is. But good morning, welcome. Seems like some of you are going in and out. Good morning, Liana. Good morning, Sarah. So you may be the only 2 in here right now. I hope you ladies had a good weekend. And thank you for submitting your names for the project that we have coming up, or the project that's going to be due this Friday. And yeah, it's a full week of school. College Now is still operating. And thank you for showing up. I don't see the rest of your class though. So we'll wait. So I guess while we'll wait, we'll test out the board. We'll make sure that it works. Let's see. If it works, please write this or post this on the chat. There's only 2 of you. Oh my God. So again, I just tested out the whiteboard. If you can just go click the link and then just type in whatever appears on that whiteboard. That'd be great. There are more of you now coming in. Good. Happy to see that. So again, the whiteboard should be up. So I'm just asking you to go there, see what's written, and post that in the chat. Just gotta make sure that we're up and running. You said it. You said it, Sarah. Rainy days. Monday and a rainy day. Oh. I mean, it's not that bad. Like I said before, it's optimal day to be at home. Good morning, Kyle. Good morning, Gianni. I know, rainy days. So hopefully, again, most of you submitted your names. Whatever names were submitted, I put that into a spreadsheet. I took a screenshot of that and I shared it on our classroom wall. So hopefully you see your name in one of the groups. If it's not there, make sure that you coordinate with others to make sure that you form a group. So I'm going to wait another minute and then I'm going to go right for it. So comfy. I think today you'll need a calculator. Ooh. Yeah, so I can't pass out any calculators. The best that we can do here, you can use your phone calculator. That will work. There are emulators out there that mimic the TI. I think there's a calculator called TI-culator or Ticulator. I believe I shared that with you guys. When was that? During stats? Maybe, maybe not. Let me see. I know if you have an Android phone that you can find the TI-84 no problem. Calculator, graphing calculator, App Store. But I'll look for something a little bit later. But today, you're definitely going to need that. So we're going to look at compound interest now. So now I'm going to move on with the lesson. I don't really want to wait any longer, considering that we only have about 42 minutes together. So the 6 of you that are here, thank you for joining us, or me. And here we go. So the last thing that we looked at was simple interest. I mean, it is possible to earn simple interest, but most of the interest that concerns us or is of interest to us, yeah, no bad joke, is compound interest. So earning interest on top of interest, and that's what typically happens with investments. Whether you're investing in a savings account or a retirement account, typically those things grow or blossom because of compounded interest. So it's really important that we understand how that works. And I think I mentioned how that works in the last lesson. Okay, so if we look here, so again, it's going to take a little bit for it to appear on your end because of the lag, so I apologize for that. So just imagine earning interest on top of interest year after year. So that's this idea. So if you invest 1,000, at the end of the year, you have 1,100, just as an example, and then that 1,100 will earn interest in the second year. So that this way you'll have more money in the account, not just because of your original investment, but because of your original investment and the interest, which accumulates or earns interest. So that's the idea of compounding. And that's why people typically invest in these retirement accounts, not because they're earning simple interest, but whatever money they put into the account over time, year after year, just keeps growing, compounding, and then hopefully by the time you're ready to retire, you have a nice, comfortable cushion. Because of all of the events that have happened, or the main event that has happened and put us into this position, a lot of individuals that have, retirement accounts, they may be complaining because they lost a lot of money, especially that all of that is attached to the stock market. So compounding works great, but at the same time, something catastrophic happens. And again, it all depends on how you invest your money. And you hopefully are investing in assets or things that are kind of safe from global events. It's really, really tough to find something like that. Typically, you can go to a bank and you can invest in a bank, but what ends up happening in a bank is that they charge or they give you very little interest. And I think we spoke about that, like less than 1%. Don't expect to make big bucks. I mean, there are other investment options offered by banks like CDs and things like that, where you can leave your money for 5 years, 10 years, whatever it is, and it typically earns a little bit more, but it's, there's rules as to then how you manage that money. There's all of these rules, and the payout is a little bit higher, but it's not like, oh my God, I'm making so much money by putting my money in a savings account. No. Typically how it works is if you risk, your money, or you invest your money in riskier areas, then you're going to get a higher reward. If you're risk averse or you're afraid, your return is going to be lower. But the reason why we care about investing is because of this idea of compound interest. So who's with us? About 12 of you. Welcome, class. All right. So let's see. So we're going to look at this next example. It's example 3. That's what's in front of me. And for those who just joined in, at the end of the lesson, we'll talk about the project and just putting some final touches, specifically the groups that are going to be attached to the project, because I know there's still some of you out there that do not have a group. Hopefully you looked at the post in the classroom wall and you finalize that by the end of this class. You know who you are. All right, so let's see. I'm trying to move the board. What happened? Okay, here we go. All right, so we're looking at example 3. Example 3 has a value of $1,000. Right, so you have $1,000 deposited into account, paying 4% interest per year. Again, the amount of interest that you're earning here, assuming that this is a bank, let's say, an account. It doesn't really say what this account is attached to. It could be a retirement account. 4% isn't terrible. I believe if you're taking economics, your teacher probably tells you about the inflation rate per year. And then when you talk about GDP and things like that, this is not going to be a lesson on economics. At least I'm not going to try to make it one. But the long and short of it, the whole thing is there's an inflation rate, and then there's a growth rate, and then there's how much you earn, let's say, in a raise per year if you're a salaried employee, if you're working, and you always want to be above the inflation rate. I forget what this is. I think Mr. Lowe should be very upset if I got this number wrong, but I want to say it hovers at about 2.5% per year. I'll stand corrected on this. You can correct me. Maybe someone can do a quick Google search on the side and say, what's the average rate of inflation per year? I think it's at about 2 to 3% maybe. But again, I'll stand corrected. I'm not the economics teacher, but it's just from what I remember. But anyway, this account is earning 4% interest. So, but it's saying compounded quarterly. So here's some key vocabulary. So compounded. So the typical compounding that I think you guys are used to are compounding per year or earning interest once a year. But you can earn interest multiple times a year. You can earn it once a month. You can earn it, twice a year, every 6 months. You can earn it here every quarter or 4 times a year. You can earn it every week, every day, every hour. It gets pretty crazy, but we're going to look at that, or the idea of earning interest continuously or an infinite amount of time, let's say. Continuous compounding, they call it. So if we look here and we apply our formula, so we have some things. We have our interest rate, which is 4%. We have a principal or a starting amount, so I'll call this P, because our formula, it's still in front of you. So our compound interest formula, A, which is some final amount, equals to the present or the principal value times 1 plus the rate divided by the number of times we're compounding. The sum of all of that is then going to be raised to the power of t times n, where t is here years and n is the number of times that we are compounding. So in this case here, deposit into account 4% interest per year. So in this example, we want to do this for 10 years. So n will equal, or t is 10, but we're compounding 4 times per year. So again, now moving along from the whiteboard, we're going to plug all of that in, all of those key components. So what we don't know is the amount that we're going to have after 10 years. But we know that today we're going to deposit $1,000. At what rate? At a rate of 4%. But 4% as a rate is written as 0.04 divided by n, which is the number of times that we're compounding, which is 4. But if you think about it, the number of times that we're earning interest for this entire 10-year period is 10 times 4, which in this case is 40. So it would look something like this. So now the slide is going to change on your end. So basically substituting everything in to this formula, and then something to think about before we actually begin calculating. So again, you do need a calculator for today. If you have your cell phone, that will work fine. It just gets a little bit tricky when you put whatever's in parentheses inside or input that into the calculator. Then you have to raise that to the power of 40. So let's see how many of you are here now. 13. All right. So what happens? So how much money are we looking at after 10 years? So if we look here, after 10 years, when this is all simplified, don't forget that inside the parentheses, 0.04 divided by 4 becomes 0.01. So this all simplifies to the following. 1,000 times 1 plus 0.01 raised to the power of 40. So 40 times you're earning interest in a period of 10 years. And at the end, in your bank account, at the end of that 10-year period, you're going to be left with $1,488.86. So I don't know. That's something to think about now. This is what the formula churns out. This is the amount of interest that you'll earn on top of the initial amount, right? The interest by itself is about $488.86. But something that you have to think about, as an investor, is that a lot of money in a 10-year period to earn? Also something to think about too, you only invested $1,000. Is that a lot of money to, as an investment? Maybe for you today, yeah, that could seem like a lot of money. Maybe you don't have $1,000 in your pocket. I don't have $1,000 in my pocket right now. I have a couple of 20s, but it's nothing really to brag about. But anyway, $1,000 in the grand scheme of things, it's not so much money, right? So if you want to make a lot of money, you have to invest bucks. Clearly, you want to invest very little and make an enormous amount of money. And that's what some people try to do. Financial planners, financial consultants, individuals that work in hedge funds, as an example. So private equity. So these types of businesses, they try to manage money, and using that money to try to make as much as possible without investing so much upfront. So it's fair, but something to think about here. It seems like it's a pretty safe investment. You invest in this account, and they're going to promise you 4%. So this is the amount after 10 years. But if we look at the next example here, how much interest? So we already spoke about this. So the interest earned. So yeah, you're going to have about $1,489 in the account, but the interest by itself, so again, in that 10-year window, you only earn it's not so little, but again, 10 years is a long time. And you could probably earn this amount of money doing other things or maybe investing elsewhere. But just so that you can see the amount of interest in this 10-year period, it's about $488.86. But then what you need to think about also is, yeah, this is you investing up front, right? But what if you're planning? So again, here I'll just put the final amount, so we're looking at the same thing. This is on the whiteboard. Don't forget the $sign. But again, what you need to think about also is when you plan for the future, you may have some amount that you want, right? I want X amount of dollars in 10 years. I don't know, maybe I want $40,000. Some of you are going to schools that are very expensive. You may be taking out loans. It depends, again, what school you're going to, but maybe you don't have to take out loans, but at some point down the road, maybe you want to buy a car. I don't know. Maybe you want to buy a house. You want to buy, I don't know, a condo, co-op, whatever it is. You want to buy something, and you don't have all of the money up front. But at some point, maybe you want to pay something in cash. So then you're going to have, were we supposed to do the homework? Hold on. Leanna, were we supposed to do the homework due today? I didn't think we went over it. So there was some flexibility with the homework. I think there were some things that we went over, but I think on Friday I made the priority. So again, I'm answering Leanna's question, and thank you for asking it. So the priority on Friday was for you to get together with your group, or establish a group, that's number one, and then begin to answer some of the questions that were asked. So if there's a homework assignment that was due today with something that you didn't cover, I'm going to go in there now, or at the end of this class, and change a due date. So don't worry about something being late, or if you didn't understand something. I'm being very flexible. So I hope that you're seeing that also, not just Leanna, but everyone else that's out there now, that there's going to be some flexibility with how we're instructing students in this environment. So don't be too worried about something being late today, or if we didn't go over something, I'm going to extend that due date. And I think as we go over what I'm doing with you today, the project is going to become clearer also. So thank you for the question, number one. And two, there'll be flexibility, so don't worry about it so much right now. But thank you for the question. So in planning, let's see. So here's the thing, going back to the idea. You want money, you don't have it today. You want to save today so that at some point in the future you will have it. So we can say, if we look at this next example, so Cece, she must pay a lump sum of $6,000 in 5 years. $6,000, wow. So we can look at our formula. So again, we're on the whiteboard, just scrolling down. So our formula is A is equal to, so in different textbooks, A, or this final value, will be represented differently. So you can think about it this way. It's basically a future value. So sometimes this formula could be called a future value of money, present value, etc. But for our conversation, we're going to use this compound interest formula to figure out how much money we're going to need today to invest so that tomorrow or at some point down the road, we see the money that we want. So Cece has this goal. She needs $6,000 in 5 years. All right, fair enough. But we have some present amount that we don't know, and we're going to have a rate, we're going to have compounding, and we're going to have a certain amount of times that we're compounding throughout the years. So in this case, 5 years. So let's just identify some things. So we know our A value. So again, scrolling down. Here, this is a future value. We want $6,000. Our time is 5 years. Our rate, how much is our rate? What amount deposit today? See, so here it's mentioned a present value. At 3.1%. I mean, the interest rate is low. But, again, this is a 5-year window. So with the low interest rate, I mean, you may think it's high, but it's okay. But again, with this interest rate, don't expect to deposit like $100 and hope that in 5 years you get 6,000. So you should start almost like forecasting or predicting, like around how much money am I going to need. So let's plug in. And we're compounding annually. So this is kind of nice. So our N, we're only compounding once a year. So our N value here is 1. So when we substitute everything in, so here we're going to have 6,000. And that's going to equal to what we don't know, P, that's what we're trying to solve, times 1 plus the rate. Don't forget 0.031, all of that divided by 1. And that's going to be raised to the power of 5 times 1. So we're basically going to be doing some algebra to solve for P. So how much money do we need today so that Cece, 5 years down the road, she has $6,000. So that's the goal. If you want, you can chime in. You can tell me. If you're doing the calculations, if you want to take about a minute, calculate it. See if you can solve for P. So if you're looking at the whiteboard, the formula has been set up. So take a moment, solve for P. So the question now becomes, and again, round to the nearest cent. Round to the nearest cent, or in other words, the nearest hundredth. So again, you're solving for P. I'm giving you some time to figure that value out. And if you figure it out, just respond in the chat. So it becomes a little bit difficult with, if you're using your cell phone to calculate, do what's inside parentheses first. Parentheses first. And then you're going to be raising whatever's in parentheses to the power of 5. Then I would divide that to both sides so that you get a value of P. Does anyone have it? Liana, Sarah, Kyle, Gianni. What do we think? Eleni, thank you so much for that. I agree. So think about it. So basically what Eleni shared, and thank you again for that, what Eleni shared was that Cece needs to deposit this amount today into this account. And then when she comes back 5 years later, she's going to have $6,000. I mean, is that a good investment? I mean, that's a different question. That's a different argument to make. But if, we're thinking about this, it's safe. It seems safe. It just says that this is an account. And if this is the goal, I need 6,000 in 5 years. Here's this account that's going to be offering me this rate. Therefore, I'm going to put this amount in. The only issue is that you need that amount today. So that's something to think about. So if you want to invest in something and you want to have X amount of dollars in the future, you're going to have to put in some money today. What amount? It depends on how much you want later on down the road. So something to think about. The next question, right? What amount deposited today? Compounded annual, what is this? Yeah, so we have that. So that's just an extension. So that's been answered. Great. So now something to think about. So if we look at the next part, if only 5,000 is available to deposit now, what annual interest rate is necessary for the money to increase to 6,000? So just let's say, for example, we only have 5,000 today. That's it. I don't have 5,150. I only have 5,000. So let's look here. So if we go here, so back to our whiteboard. So now that the question is this, we do want 6,000, but today we only have 5,000. So what we want to figure out is at what rate. So what rate do we need? So, excuse me. So again, it's going to be the same amount of compounding, right? I don't believe that changes. So here it says if only 5,000 is available to deposit now, what annual interest rate is necessary for the money to increase? So our n is the same, which is 1, but we don't know the rate. So that's interesting, right? So the question kind of then is forcing us to find an account, if you want to think about it, a bank that will give us a certain rate to work with the money that we have today. So why don't you try solving for this now? So again, everything has been set up for you. What we're trying to find is the rate. $3.7%. So let's see. So hopefully we did the following, and thank you for that, Eleni. So if we look, so this is the substitution, right? This is what we did on the whiteboard. So we can get rid of, or we have to try to isolate R. So it's easy to, divide out 5,000. And if we do that, then we're left with this. So we're left with 6,000 divided by 5,000. All of this is equal to 1 plus R raised to the power of 5. But we can get rid of all of these zeros. So it really becomes 6/5 is equal to 1 plus R, all of that raised to the power of 5. So how do we get rid of that 5? So this goes back to the rules of exponents, right? How do we get rid of that? What do we need to do? So we can't take the square root of both sides. So we have to take the 5th root. Or, if you don't like that, remember how we rewrite the fractional exponents, right? The top piece is what we're raising, or the numerator is what we're raising the whole base to. The denominator becomes the root. So this is one option, but if we scroll down, so again, just scrolling down on the whiteboard, you could have rewritten this as 6/5. All of this is equal to 1 plus R raised to the power of 5. But if we multiply everything or raise everything to the 1/5 power, that also works. So that's basically what I have now here in front of me. So to solve for R, we have to take 6/5 and raise that to the power of 1/5. Or take the 5th root of 6 divided by 5. And if we do that, according to Eleni, who is correct, by the way, it's going to be about 3.7%. Here I didn't tell you how to round, so I rounded to about 3.71, or to the 100th, but it is correct. So in other words, we think about the original example. The original example only offered us 3.1%, but that forced us to put in 5,150. So since this investment, or this account, is offering a higher interest rate, then we can put in less money. So that should kind of make sense. Or it should be logical, so think about it. An account has high interest rate, you have to put in less to make more. An account has low interest rate, you have to put in more to make less, not necessarily less, but to make an amount that is probably something that you don't want to make. Or you do, but it just doesn't grow as fast as you would like. So there's all of these factors: time, interest rate, the starting amount, how much you want at the end of the investment. So all of these things, play a role. But I think the interest rate may be the most important. So there's some examples here that you're to try on your own, but because of time, I'm going to give you that. So here, take a moment You can take a picture, and this is something that you can do independently. So again, it's just because of time, and I want to make this time that we have together, what, the 42 minutes, which is really not enough. But this is for you to try independently, so please take a screenshot, take a picture, and this corresponds to the previous two questions. That's in the try on your own section. So how many of you are out there today? Oh, I just saw your response, Brittany. Thank you for that, by the way. So 16 of you. All righty. All right, so moving along now. So the next section is going to deal with continuous compounding. So basically something that I mentioned earlier in the class, because we can earn interest in, an infinite amount of times. So for example, you can earn it every hour, every minute, every second, every millisecond. But at some point, though, you're going to have to say to yourself, when is enough enough? And mathematically speaking, that does happen. So we're going to look at this idea of compounding infinite amount of time. So the more often interest is compounded within a given time period, the more interest will be earned. Surprisingly, though, there is a limit on the amount of interest, no matter how often it is compounded. So that's the whole thing. Like at some point, it just becomes insane. Like, do we go so deep into this compounding, right? So there must be a point where we're going to hit a wall, or where the return is going to be so minimal that it just reaches this cap. So as an example here, we can look at this scenario. So suppose that $1 is invested at 100% interest per year, compounded n times per year. Then the interest rate is 1.0, and the interest rate period is 1 divided by n, according to our formula. So the compound amount at the end of the year will be as follows: 1 plus 1 divided by n raised to the power of n. But look at what's going to happen here. So this is where it gets a little bit abstract. So if we're compounding one time in this scenario, where we're earning 100% interest as an example, then the output will be 2. If we're compounding 2 times per year, then the output will be about 2 1/4. So now look at what happens when we go from 5 to 10 to 100 to 1,000, and then here it stops at 1,000,000, because at some point the amount that you're going to get back is going to be less and less with all of the compounding that occurs. So if you're compounding 1,000,000 times, or even 2,000,000, 3,000,000, the amount is going to hover at about 2.71. So this value, where as we compound, our return really doesn't go past a certain value, and in this case it's 2.71. This value is called E. So E is a real number, and it's not a variable. So it's kind of like pi. So it's just a symbol to represent some real number, although not necessarily rational, but it is a real value, and it's approximately 2.71. So I was going to show you this video. So when I planned for this, I was planning to be in a classroom. But if you look up this guy, Numberphile, actually, you know what? I'm going to share a link. So hold up. Let's see. Hold up. Numberphile e-history. Let's see. All right. So this I'm going to share with you. It's going to go right in this chat, and this could be for you to watch on your free time. I think the first 4 minutes will cover it. So this should have now gone live on your side. You don't have to click it now, but this goes into a detailed, basically analysis of this previous slide. So if I go back. So basically this gentleman in the video, he'll go into that chart. But he's a little bit more descriptive, a little bit more lively. He does a lot of drawings. etc. So that will be clarified significantly more, or it'll be illustrated in a different way, so that if this is a little bit confusing to you, it'll be completely clarified in the video. So just to speak English for a second, you want to compound an infinite number of times, you're not going to go too far. It's going to stop. There's going to be a wall. And that wall is about 2.71. Instead of calling it a wall, we're going to call it the letter E. And the letter E will represent continuous compounding, which is about 2.71. So this is our formula for continuous compounding. A is equal to PERT. So if you want to remember that, especially for a future exam, and I still have to think about how I'm going to give an exam in this class. I'm probably going to do it through Lumen Learning, I think, for the most part. I don't know. It may be also take-home exam. I really haven't thought about it. It becomes difficult in this environment, so don't stress about it. It's going to be manageable, and it will come soon. It will come very soon, but probably more details tomorrow, but definitely by Friday. So the exam is coming. It's going to be manageable. Obviously, you're going to be able to do that from home, so don't stress. There's going to be some flexibility, some freedoms, and every opportunity for you to do well. So just breathe. Alrighty, so here's our formula, where P again is going to be some principal amount, some starting amount. E is going to represent our continuous compounding. So we know that if we have a situation where we're compounding continuously, we're going to have to use this value of E, but certain things are still the same, the rate and the time. So if we look at this next example, I believe it's similar to what we had previously. So now if we look back at the whiteboard, so I'm going to use that, again scrolling down. So we have the following. So here's our continuous compounding. Don't forget PERT if you want to remember it. So here we have a beginning amount, or a principal amount of 5,000. And apparently it says here that it's 3% interest compounded continuously. So then that enables us to use E, but our rate, we're told, is 3%, or 0.03. Don't forget to convert from decimal to percent, or excuse me, from percent to decimal. Sorry, don't forget to convert from a percentage to a decimal. So here we have 0.03, and what is our time frame here? Compounded continuously for 5 years. So E, it should be in your cell phone. If you have your TI, I have to grab mine. I'm not near it. Hold on, let me just load it up. So some of you do have a TI, which is great. If you don't, you should have it in your cell phone. I'm going to try to find it in the calculator where it is. If you go landscape, if you again just tilt your phone, E is there. It's next to the double E, or if you look at number 1, so if you see 1, to the left of that is double E, and then to the left of that is E. So it is there. Again, I'm talking from an iPhone perspective. I only have an iPhone. Sorry, Android users. I'm sure you have fancier calculators, but if you have an iPhone, if you tilt your phone landscape-wise, if you look at number 1, or the button for 1, to the left of that is double E, and then to the left of that is E, which is the number that we need. So we're going to raise all of that to 0.03 times 5. So basically what we end up coming up with is the following. So imagine this: continuous compounding for 5 years, 3% interest, earning interest an infinite number of times. We're going to end up with this value after 5 years. So you should be thinking about something, because I think we had a similar investment earlier in this section where we deposited $5,000. I think it was at 4%. I think 5 years or 10 years, I forget. But this is something to think about, how much money we end up with at the end of that window of time. So in this case, if you did everything correctly, using E correctly in the calculator. And let me just see where it is on the graphing calculator. Just give me 1 second. Where are you? Here you are. So E is the division symbol, second division symbol. So if you have a TI-84, E is second division symbol. Alrighty, so in doing this, you'll have about $5,809.17. So 5 years, 3% interest compounded continuously, you would have earned about $809 in interest. So again, this is kind of going back to what we were looking at before. So in an earlier example, we found that $1,000 invested at 4% compounded quarterly for 10 years grew to about 1,488. So if we were to do the same formula or using continuous compounding instead, we would have differences for sure. So this is something that kind of puts everything together, kind of going back to our original example. So 1,000, we're investing at a rate of 4%. We looked at, I believe it was quarterly, but look at how it changes when we do it or when we compound at different times or different amounts per year. Annually, semi-annually, quarterly, monthly, and you can take it. I think this might be in your notes. If not, I'll include it. You can take a screenshot. But notice continuous and compare that to quarterly. It's not that much of a difference. So again, the idea of continuous compounding, it sounds attractive. It does. It's like, wow, I'm earning interest all the time. But there's a wall. It stops. And that wall we call E. And we use that with our formula, our PERT formula. So when we need to find an amount that is growing continuously, we would apply that. But more importantly is just to see how much money you're really earning with different types of compounding. So I think that's it for today. So here, I want to give you the solutions at the very least because there's some try on your owns at the end of this. So please take a picture of that. And then we'll quickly talk about the project. So I'm hoping that you submitted the forms. So I'm just going to look at that quickly before you leave. Let's see. There's about 16 of you here. Great. So let's see. We're almost done. So I just want to make sure that everyone submitted their groups. I hope that happened today. Let's see. So do you have any questions for me while I'm loading up this forms file? Any questions about the project? Any questions about the homework? Any questions in general? All right, I'm still trying to find this. My computer's running a little slow. All right, so there was 5 groups. There should be 7 as of today. Where is this? I do not see it. Great. All right, so I'm having an issue finding the actual entries right now. I don't know why. Let's see. Thank you. All right, so that's it. All right, perfect. So again, I'm going to double check to see that all the groups are in place. The project is still due this Friday, so if you have any questions, please make sure to, you can email me. You can submit a post through the actual classroom, which is fine. I think someone did that last week when they were trying to find another group mate, and that works well. But if you don't have any other questions, we're done for today, and we'll continue this again tomorrow. So the homework I will adjust, so don't worry about that. And that's it for today. Have a great day. Yeah, it's raining, but since we're going to be inside, it's not, so terrible. But try to have a great day regardless. And I'll see you guys again tomorrow. Bye.